Hi, everyone. It's John from Rain King LLC. It's time for a general market update. It's June 2nd, 2023. First of all, I want to thank everyone for all the condolences sent for my father's passing. I really appreciate that. Thank you so much. Again, a reminder, Rain King is an individual growth stock investing, and we're not affiliated with IBD or MarketSmith. So the agenda today is the big picture. Then we'll get into a little closer into the current market, go over our internals in the market, and then we'll go over a segment called Know the Animal You're Trying to Kill. And we're going to get into some names to watch specifically. And we'll do a summary, and then I'll talk about the special lecture series on Jesse Livermore. So the big picture first. I've shown this a couple times in the past few months. On the left is 1962 bear market, and I'm using it kind of as a precedent for 2023 on the right. The idea is three waves down, the second wave being the climax washout selling in 62. We had our climax washout selling, I believe, in June. Then we had the low, and then we had a retest of the low. Now, the retest of the low in 62 coincided with the Cuban Missile Crisis, eventually pulling out of there once the crisis was resolved. In our case, we've had a couple retests. The second retest, occurred in March, and we had a crisis, the regional banking crisis. We seem to have stabilized a little bit, and the market is still grinding its way higher. In the back of our minds, we still have the January trifecta. When you get those three things to line up, the average gain on the S&P is 17%. If we were to use that, it would set a target of 44.92, which from where we are yesterday would be another 5.2% gain. We looked at this, the NASDAQ weekly chart. We were just looking at some lines of resistance. The 13,150 level, which would be a 50% recovery of decline, was a potential resistance zone. So let's look a little closer at what the index is doing. So here is the index as of today, and I'm recording this about 11:45 Eastern time on Friday. I've talked about this line of resistance, and we talked about these corrections getting tighter and tighter and tighter. And I put out a tweet in late April, basically commenting on there was so much bearishness and bearish positioning that maybe we could get a false breakdown that would actually surge higher. So we've actually gotten the surge higher. But what I'm looking for is in this surge higher for the next leg is I want to see the market broaden out. I want to see breadth improve. So let's see what's happening here. Are we improving in the breadth? So let's go to the market internals. This is the S&P New York stocks above their 200-day moving average. You'll notice that we're currently way down at 40%, which is really, really low. You can notice that when you have rallies in the market at new highs, you can see back in February, we had gotten to 75% of stocks were above their 200-day, and we were attempting some relative new highs. Today, we're attempting to break out of this consolidation, but the percentage is all the way down to 40, with the index at an 8-month high. That's a divergence. It's a negative divergence that we really want to keep our eye on. Looking at new highs and new lows on the NYSE. Again, rallies, which I've highlighted in the peach color here, is when you get rallies, you want to see net new highs. You can see it happened here. It even happened briefly on a rally we had in late March. But the current move, there have been no net new highs. And if you look at the advanced decline line, which is not shown here, it's also very, very poor shape. Turning to the NASDAQ, net new highs, new lows, very similar picture. We're getting no troops here. We're not getting any net new highs. We had a couple of little days, but nothing significant. So when we look at breadth and look at the internals, one thing we can always expect, if the market is down, we can expect to see bad breadth on a down day. What's more concerning to me is when you have bad breadth on a seemingly up day in the markets, because it's really masking some weakness under the surface. So specifically, looking at the S&P 500, here's last Thursday's bar. You had all this juice from NVIDIA's report, and all the AI names were moving, and we had a lot of excitement in the market last Thursday. Now, the S&P was up 0.88%, but if you looked under the hood, the breadth was very poor. It was actually 2-to-1 decliners over advancers. That's what I mean by bad breadth on an up day. The index is up, but under the surface, not many stocks are participating. And that on that exact same day where we had the QQQs and NVIDIA moving higher, the NASDAQ actually had new lows expanding. So that's very concerning to see that kind of action. So it's very narrow still. When we get new highs in an index, we would need to see confirmation in the advanced decline line and or net new highs, new lows. So these types of divergences, though, these can last quite a while. But I will say, historically, these typically don't end well. So be on caution a little bit as the market unfolds. That said, there is money to be made depending on your time frame. So you really need to know which animal you're trying to kill, and you need to be a sharpshooter. So let's take a look at this. Which animal are you trying to kill? So it depends on your time frame. If you're a day trader, a swing trader, these moves in the AI names, the headlines, some of the news stories, you can certainly make some money if your time frame is a day or a couple days, 2-3 day swings. So you can actually make it work. Being a position trader like myself and other position traders out there, this is not really a market to have any heavy exposures. I do think some pilots are warranted, some small positions that maybe you could build over time. You're going to need to be patient because it's not a runaway bull. Now, there's no doubt that AI is a game changer going forward, and it could be one of the major themes of the next bull market, the next big bull market. And AI is going to take probably a 5 to 10 year window to play itself out, along with a bunch of other themes such as EV and personalized medicine, blockchain, Bitcoin, etc. Now, currently in the AI world, it's the infrastructure names that are getting attention. The chip stocks, the networking stocks, data analytics, even some of the enterprise security stocks are getting a lot of the attention and movement. And I've just put a list there. You know what these names are. You've seen them move. They've made some pretty dramatic moves in the past couple of weeks. Now, after infrastructure, we might start to see some of the software application stocks that start to really develop AI for practical applications that get results. So what it could mean is, looking ahead in the future, we could get a bunch of IPOs in 2024 and 2025, which could be new names and new leadership, would be very positive for the market around the AI theme. Now, it's important to avoid FOMO. You're not missing anything yet on AI. Just because NVIDIA made a big move, and it is one of the absolute big leaders of the market, they will present other opportunities to get in. The leading stocks are starting to show themselves, but you should just stalk them and watch them to try and find a way to get into them. Watch for new bases, pullbacks to the 10-week line, tight areas, etc. Again, AI is going to play out over a multi-year phase, so it's important not to chase. And I think it's important to also say, when you haven't made any money in the last 12 to 18 months or very small amounts, any drip can bring lots of excitement. And there certainly is a lot of excitement around AI, and it's warranted as a new technology. But just remember, though, in 1990, when Cisco broke out of its double bottom base, if you missed that initial breakout, it was not a case where you had to be chasing the market. There were plenty of opportunities to get into Cisco over the next 5 to 10 years. Cisco, I believe, went up over 70% in the 1990s. So try to resist the temptation to chase something that's very extended. So looking at some of these names here, NVIDIA, Supermicro, and Rambus, They're certainly very extended right now, but it's interesting. I showed the GMU Extra, and I talked about RIM, and we heard about how Bill analyzed what was going on in a big leading stock. These are three big leading stocks at the moment, and they're showing accumulation characteristics. This blue box is showing when we have 5 weeks up in a row or more, which is a nice positive sign of accumulation. And the teal dots are representing very tight weeks, 3 weeks tight or more. So you'll notice that multiple signs that these stocks were being accumulated as they're now really launching higher. What's really important now is to watch these stocks to see if they can hold these big gains. If they can hold these gains, within 10 to 15% of their highs, it would tell us that institutions are really there gobbling up shares, and they're not going to let the stock fall back too much. Now, if they completely wipe out these gains, then you'll know that the move is probably not real yet. So, looking ahead to tomorrow's leaders, when we look at innovative companies, the ARK Innovation Fund and the Renaissance IPO ETF, we're going to see these particular ETFs, they're bottoming out now. You can see them both. But again, this could be fertile ground for 2024, 2025 with leadership, with innovative names and products. So keep an eye on these types of ETFs. Now let's look at some specific names that are showing some signs of accumulation, and they're all relatively young names and relatively new to the market over the last 1 to 2 years. Here's Double Verify, these are all weekly charts. Double Verify has had a prior uptrend. It's tried to form a base. I don't like it how it's kind of sloppy, but you can see there have been some tight weeks of accumulation. You can see some blue spikes. It's one to keep an eye on. Still has some overhead resistance on the left side. Duolingo is an interesting one that's been acting well. We had really a shakeout occur down to the 50-day moving average on earnings, but it recovered very quickly. Had some consecutive up weeks in a row. It's also got an AI component to it, and you can see big blue spikes showing accumulation. Interestingly enough, I cut these charts last night, and IoT Samsara on a weekly chart was another one that I identified, 8 weeks up in a row, and then it basically moved fairly sideways, though it was choppy. It tried to break out, and then it came back in, not unlike some other stocks that we've seen. And MongoDB also, I've highlighted this in yellow because as the stock bottomed out at the end of 2022, look how volatile this stock was in 2022. Wide swings on the decline. Now look in 2023. The spreads are so much tighter, and look at the closes. The closes are showing us that this stock is being accumulated, and it's no longer wide and loose. I also had 7 weeks up in a row, and as I speak, it's gapped out today, and Samsara has gapped out on earnings as well. So these stocks are starting to get some attention. One is in the database management, and Samsara is also AI enterprise with basically truck fleets of cars. So summary. We still have to acknowledge that there are divergences that are continuing, and they're actually more pronounced now that the index is at new highs. So in order for this to really sustain itself, we need to see the breadth improve, at least incrementally. Things are very stretched in the short term in some of these AI names, so even the QQQs are getting very stretched. So it's important to watch the next pullback. If we get a nice easy controlled 3 to 5% pullback, that will be very constructive. If it becomes much deeper than that, when we start to fail at the previous resistance level, which should act as support, we could be going for a more deeper correction of maybe 8 to 12%. So it's something to keep an eye on. Again, we're trying to understand if this is a really an on again, off again rally, or is this the real deal? And I won't belabor it again, but we need to see the breadth improve. The market is still pretty narrow, which makes it kind of vulnerable. In my opinion, as a position trader, it's still a fairly go slow environment. I do think some pilots and some positions, maybe 0 to 20%, is a decent level at this stage, but there's no problem being in cash as well. So the cross currents continue. So just because you're very, very hungry and somebody tosses you a cracker doesn't mean you should eat it in one mouthful. So incremental, I think, is the way to go in this market right now. Build positions over time and be patient and avoid FOMO. So I wanted to make the announcement again that I will be presenting a special lecture series on Jesse Livermore. It'll be a 3-part lecture series starting on June 13th. If you go to my Twitter feed, and here's my Twitter handle, go to my Twitter feed and you'll see in there a tweet about the Jesse Livermore series. The first link will take you to a 2-minute video that will describe to you what this 3 series is all about. And the second link will be the registration link if you want to be a part of this series. I think it's going to be pretty special, and I'm really hoping we can maximize people that can take advantage of Jesse Livermore as we dig into some of his greatest trading lessons, as well as we cover some of his blunders. So that's the general market update for June 2nd. I hope everybody has a great weekend, and we'll see you soon on the next general market update.